Joining us is Steve Liesman. He is CNBC senior economics reporter. Our guest host is Barry Knapp and John Taylor, who's Hoover Institution senior fellow and also former undersecretary at the Treasury. Steve, just start with you. From the numbers we just heard, all good numbers. What's the
Let me completely undo the great understanding you have of the data from Rick, and I'll just confuse you. First of all, the main thing that we were looking for this morning was whether or not jobless claims had 3 weeks in a row of stronger numbers. They did not. They came back down. So that's a kind of like relief that the job market's not deteriorating. There's a full expectation, by the way, that claims should be rising right now in the cycle we're in because claims tend to rise in a period after employment peaks. So it wouldn't be unusual, but it didn't happen. So that's good. I was primed and ready to explain away a decline in capital spending because of the GM strike and because of Boeing. Instead, we got this anomalous rise. That's also good news. You've had a couple lousy months. Let's put that. Those negative signs are out there. You had a strong negative 1.4 in September. It's up 0.6. There's a lot of volatility in this number. The business investment proxy of 1.2% is strong. It has been negative. I'll need to see another couple months to see if we put behind us this investment scare or this investment drag we've had on the economy due to business spending. And then I'll just say GDP 1.9 to 2.1. I'm not going to get very excited about. I like the idea the consumption number was a little better.
John, what do you think? Putting this in context of all the numbers we've been getting over the last several months, it does seem like we've avoided that potential recession.
Yeah, I think the numbers are good. As Steve has indicated, it's got some upticks in important areas. I'd like to see growth higher, obviously. 1.9, 2.1 is an improvement, but ultimately we can go higher than that. And I think it's news because the expansion's continuing. People had been worried about that, but this alleviates some concerns.
What do you think's holding back growth at this point, if you think we should be higher than 2.1%?
Well, I think one of the issues, the policy on the tax side has been good, regulatory side has been good. I think the budget's still out there. People are beginning to think about it. I testified in the House Budget Committee last week, so attention's being brought to that. And so that could be the next thing. To get that straightened out, I think would be beneficial to the economy.
A question for Dr. Taylor. I don't know if you happen to see it, but this was the first look at GDI, right, gross domestic income, and it printed 2.4, which is a better print, obviously, than the GDP number. I actually think the income number is better as a sort of a proxy for the business cycle and, you know, for corporate profits and revenues and all. Do you have a point of view on that GDI measure as opposed to GDP?
I didn't get a chance to study it yet, but it's more positive than the others. It fluctuates
2.4.
around. Yeah, it's more positive than 2.1 and 1.9. It fluctuates around a bit, but it's another factor to look at. I agree, it's a positive number. Actually, I would say we can be even better than this with the policy, as long as we don't have tax increases and regulatory rollback and things like that. I think this expansion is continuing, and that's what the data is trying to tell us. And we should make sure the policy doesn't try to disrupt that.
John, speaking of policy, how about monetary policy? 3 rate cuts this year from the Federal Reserve. They abandoned their policy of reducing the balance sheet. In fact, something that I think was near and dear to your heart, the idea of normalization, it's kind of out the window. So what is your take on policy right now? Is it just right?
I don't think normalization is out of the window. I think this was an adjustment based on their assessment of the economy. The stuff in the money market, they're still working through that. I'm anxious to see what the decision is going to be. But I think now you have to think about this globally. It's a situation where a large part of the world economy still has negative interest rates. There's got to be normalization there. And I think the Fed is part of that. And I still think we're moving in that direction.
Quick word, Dr. Taylor, on interest rate caps, given Lael Brainerd's speech yesterday.
Yeah, how about that?
Perspective on that one? We did that, by the way, 42 to 51.
Bring everybody up to speed. Lael Brainerd, the Fed governor, I think became the first governor to publicly talk about it. It was in the minutes of the last meeting, but the idea that in the event of a downturn, once the Fed hits zero, the Federal Reserve might go out and buy paper to the point of capping interest rates, she said, on the short to medium term, essentially to what's the word? Engineer the yield curve. John, and just to bring viewers up to speed, your comment on that. Yield curve control, Treasury rate caps.
I don't think it's a good idea. Basically, it's more interventionist in directions of the yield curve. I think what's happening now, it's promising. The Fed is thinking about what happens if there is a movement in that direction. Actually, I think one of the promising things, they're looking at different kind of rules, much more than they have in the past. That's normalization to some extent, looking at policy rules, and that's a good development. I think to look for more interventions at this point is really not the way to be going. That's not part of normalization. That's not part of why the economy is doing better. It's done better in 2017, 2018. I think it will continue if there continues to be this degree of normalization, which is clearly there still in the data.